the past decade, the geopolitical chessboard has undergone a dramatic transformation, and energy has moved to the center of the board. Where oil and gas once quietly flowed between nations under the radar of political noise, they are now at the heart of major power struggles. Few examples illustrate this more sharply than the sudden collapse of energy trade between the United States and China, two of the world's largest economies, now navigating not just a trade war, but an energy cold war. Once considered partners in an evolving global energy network, the US and China now find themselves strategically drifting apart. What happened? How did American tankers, once welcomed at Chinese ports, suddenly disappear from the map? And what does this mean for the future of energy, global markets, and geopolitical stability? In this episode, we peel back the layers of this silent confrontation, from the rise and fall of US oil and LNG exports to China, to Beijing's shift toward Canada and Russia, and the long-term consequences for global supply chains. We explore how a hidden front in the trade war may shape the next decade of global politics. Let's begin with a time when things were different. Back in the mid-2010s, the US shale boom was rewriting the rules of the global energy game. Massive investments in fracking and horizontal drilling had transformed America from a net importer into a major exporter. Energy independence wasn't just a dream, it was becoming a reality. For the first time in generations, the US had the ability and the ambition to project energy power abroad. China, on the other hand, was facing the opposite challenge: how to secure enough energy to fuel its meteoric economic rise. With limited domestic oil and gas production, China's dependence on imports was only growing. The two countries, despite their broader tensions, appeared poised for a pragmatic energy relationship. The US had supplies, China had demand. It was a natural fit. And for a few years, it worked. Tankers full of American crude oil crossed the Pacific. US-produced LNG was regasified in Chinese terminals. Billion-dollar contracts were signed. There was talk of a long-term energy axis between Washington and Beijing. But then came the tariffs. The Trump administration, determined to reset America's trading relationship with China, launched a sweeping campaign of economic pressure. Tariffs were imposed on hundreds of billions of dollars worth of Chinese goods. Beijing retaliated with its own duties, targeting key American exports like soybeans, electronics, and crucially, energy. At first, the energy impact was subtle. Contracts still held, deliveries continued, but the chill had begun. Slowly, deliberately, China started winding down its purchases of American oil, then LNG, and soon the numbers fell off a cliff. The drop was staggering. By 2024, US crude oil exports to China had plummeted by nearly 90% compared to just a few years earlier. The once busy shipping lanes between the Gulf of Mexico and Chinese ports fell eerily silent. And in LNG, the situation was even more dire. Not just a decline, but a collapse. Projects that once envisioned a strong China-US gas corridor now lie in uncertainty, some even cancelled outright. So where did China turn? It pivoted north, to Canada. Quietly but decisively, Beijing restructured its energy procurement strategy. Canada, with its vast reserves of oil sands and growing LNG capacity, became a new pillar of China's energy plan. Unlike the US, Canada maintained a relatively stable and predictable diplomatic relationship with China. No trade war, no tariff escalation, just business. Canadian crude exports to China surged. Western Canadian Select, once limited in its reach, found a new premium market. Export terminals along the British Columbia coast began scaling up, and companies that once focused heavily on US markets began looking westward, across the Pacific. At the same time, China diversified further. Russia, long a regional energy player, became an increasingly important partner. The Power of Siberia pipeline, launched in 2019, began pumping billions of cubic meters of natural gas from Russian fields into Chinese homes and factories. And it didn't stop there. New LNG contracts were signed with Qatar and Australia. China's energy map was redrawn, and the US was no longer part of it. This redirection isn't just about replacing barrels and BTUs. It's about reshaping infrastructure, financing, and long-term political alignment. China has invested billions in new port terminals, pipelines, storage facilities, and maritime logistics to support its post-US energy strategy. These aren't temporary adjustments. They are structural transformations, built to last. For the US, the consequences are profound. American energy producers, especially in Texas and Louisiana, have lost one of their biggest and fastest growing customers. The drop in Chinese demand has forced producers to search for new buyers, often in markets with lower margins and higher shipping costs. The promised energy dominance of the United States has encountered an unexpected roadblock, not from competitors, but from geopolitical fallout. And the pain isn't just economic, it's strategic. Energy exports were supposed to be a tool of influence, a way for the US to build alliances, secure leverage, and stabilize trade imbalances. Losing China as a customer means losing that influence in one of the most strategically significant regions in the world. Meanwhile, prices tell their own story. Global oil and LNG markets have become more volatile, not less. As trade routes fragment and long-term supply deals are disrupted, uncertainty has become the norm. Futures markets respond not only to supply and demand, but to headlines from Beijing and Washington. A single tariff announcement can move prices more than a natural disaster. In such a climate, producers and consumers alike face growing costs and shrinking predictability. And let's not forget the environmental cost. Many of the new routes China is building, especially overland through Central Asia and Russia, involve dirtier extraction methods, less regulated emissions, and less transparency overall. The collapse of a cleaner, more efficient US-China LNG corridor could have long-term climate repercussions. Politically, both sides remain entrenched. For the United States, the loss of China as an energy partner is often framed as acceptable collateral damage in a larger economic confrontation. But critics argue that the damage is self-inflicted, that energy should have remained a zone of cooperation, not conflict. China, for its part, views the situation through the lens of long-term security. In Beijing's eyes, dependence on any single foreign supplier, especially one perceived as hostile, is a weakness. Diversifying away from the US isn't just retaliation, it's insulation. So where do we go from here? Rebuilding the US-China energy trade would require more than just policy shifts. It would demand trust, predictability, and the willingness to de-escalate broader tensions. None of that appears likely in the short term. If anything, we're seeing the opposite: growing decoupling, intensifying rhetoric, and further bifurcation of supply chains. Canada and Russia, while stepping in, cannot fully replicate the scale or flexibility of US energy infrastructure, but that may not matter to Beijing. The long game is about resilience, having enough suppliers, enough routes, and enough options to never again be held hostage by political decisions half a world away. Over the next 3 to 5 years, we are likely to witness a further hardening of these new alignments. Energy will become more regional, more politicized, and, paradoxically, less global. The golden age of open energy trade may be ending. In its place, a new era is emerging, one defined by security, sovereignty, and strategic independence. In conclusion, the fall of US energy exports to China is not just a trade statistic, it's a signal, a sign that globalization's most essential commodity, energy, is being redefined by politics. Whether this is a temporary rupture or a permanent fracture remains to be seen. But one thing is clear: China delivered a blow to the United States, or perhaps the US delivered it to itself. Either way, the energy relationship between these two giants may never look the same again. And as the world watches this shift unfold, the ripple effects are already spreading across oceans, pipelines, economies, and decades to come.